We have a busy noon time today. I'm very excited, so I don't want to miss a single step. The advantage of having you here. Okay. We have a very distinguished group with us. This seminar, as you must know by now, is related to the presentation of a World Bank Financial Development in Latin America and Caribbean book, a book that just came out. We had plans for this for some time, but I never imagined that it would be so timely. So here we are in the midst of the beginning of a credit crunch, discussing the case of Latin America, taking the pulse of a very interesting region. As you know, Latin America was the epicenter of many crises in the past, but more recently, especially around the Lehman episode, it showed that it had done the homework in many angles, and the current account that was chronically in deficit in the region became positive prior to that crisis. Dollarization, which was another big problem, tended to diminish, not disappear. And the banks were relatively insulated from the shocks in the advanced economies. So it's not a steady state that we are looking at. We are looking at a region that has learned and has improved. But at the same time, as the Lehman episode showed, it's still a region which is vulnerable. For example, Chile, which is the poster boy of the region, output fell by around 2%, even though fiscal policy was extremely expansive, more than 4% of GDP, and the credit crunch was one of the largest in the region. So there are vulnerabilities that we are still now beginning to understand. Of course, the question is raised at this point is whether if the situation in Europe deteriorates, how is that affect the region? Will we have a Lehman 2 in the region? What are the conditions for that? And so on and so forth. So this is simply to highlight the statement that I made at the beginning, that this presentation today, this book, is extremely timely, but it not only concerns those that are interested in the region, but I think at this point the experience of this region, the variety that you can see in the region, and the variety of lessons from this region is very unique. And well, we have. I'm really delighted to welcome my friends for many years from the World Bank. In particular, we have Augusto de la Torre. He's one of the coordinators that is going to be presenting the book. They will take care of themselves. They are grown-up boys. And so after I finish here, I will sit and enjoy. So please join me in welcoming them with a warm round of applause.
Thank you, Professor Calvo, for your words and for hosting the event here. We are very grateful for that. My name is Sergio Jelinek. I'm the External Affairs Manager for Latin America and the Caribbean at the World Bank today. We have a format today that is going to be divided in two blocks. The first block, in which Augusto de la Torre, the Chief Economist for Latin America and the Caribbean, will do the presentation of the book that he wrote together with Alain Isis and Sergio Schmuckler, will be broadcasted live through the web. And after Augusto's presentation, we will have comments by our two distinguished panelists. You have their bios with you in your seat, but just to mention a couple of words. Charles Calomiris, to my left in the corner. He is a Henry Kaufman Professor of Financial Institutions in the Faculty of Business and Professor of International and Public Affairs. And Arminio Fraga, a well-known economist, is a member of the G30 and former president of the Central Bank of Brazil. So what we intend now is we start with a presentation from Augusto, then we go to our panelists that will make comments for about 10 minutes, and then 10 minutes each, and then we go to your question, comments, and everything will be live broadcasted through the web. Augusto.
Well, thank you very much. Thank you all for coming, and thank you in particular to Guillermo and Sara who have helped us host this event. We're excited to launch this book. We hope that it will be a textbook for you guys, so get ready for some of the I will not go into the complications that you will receive perhaps later on in class, but I'll try to summarize some of the main messages and ideas of the book. Let me quickly move through the presentation by saying that, exactly repeating what Guillermo has said, except adding one more point. There is probably very few regions in the world where the debate on how to promote financial development has been as vigorous and as controversial as Latin America. Latin America, in fact, has gone, when you look at Latin American history, through major swings as to how we think about finance. We that are of older generation remember the times where the state in Latin America was deeply involved in finance. The governments in the region did not trust financial markets to do their job well, and so it took control of financial systems for many years. During the 60s and the 70s, we only had either public banks or the private banks were so controlled by the public sector that the private banks were essentially instruments of resource mobilization, resource allocation done by the public sector. And then we went to the other extreme. We went into the time of the Washington Consensus, where we thought that the state had really damaged the possibility of financial market development, and we went into the idea that markets should breathe, and we should let them space to develop. And we did that, and in an early version of what was about to happen, we had Carlos Diaz Alejandro's paper that said, goodbye financial repression, hello financial crash. In fact, the period of great market liberalization that Latin America lived through generated quite a bit, or was associated, whether it was a cause or not, it was associated with a great deal of financial instability, and Latin America had to manage many crises. And we became experts on that to the point that we are now sending TA to Europe, and to the US. We have all the Argentinians available for technical assistance in Europe. But that was a long period of pain and suffering where much of the financial instability was associated with macroeconomic instability. And then we are now living in a new period where we're trying to create more stable macroeconomic and financial systems. And since 2000, you have seen in the region a major drive to try to promote financial inclusion, to make our financial systems more inclusive and bring SMEs and bring households into the financial system. So major swings. That's one reason why we thought it's a good time to do this type of report. We have debated so much about what to do financial markets, time to see where we are. The second one is precisely the second reason to do this report was precisely what Guillermo was saying. The Achilles heel of Latin America was financial crisis. It was Latin American trademark. And now it seems to be healing, at least as if you judge from what happened in the last crisis, and by the fact that financial market problems are no longer in Latin America. They are outside Latin America, which is great news for Latins. We were used to have our own problems, and so that's important. And so this report or this study tried to take a stock of where we come from, where we are, how financial development has progressed, and there are essentially kind of two big questions behind this report. One is, can our financial systems that now are becoming more stable, can they become more useful? So we have more robust financial systems, more resilient, but don't seem to be very useful for growth and for well-being. So that's a question. Can we make these more stable financial systems more useful to the economy and do it in a way that doesn't create financial instability? And then the second question is how do you preserve financial stability going forward, given what we have learned from the global crisis, where many of the paradigms as to how financial markets behave are under a revision. So the way I will present this quickly to you would be in 3 sections, in 3 acts. Act number 1, I will show you some pictures that illustrate that progress that Latin America has made in financial development. Act number 2, I will show you some of where the major gaps that we identify in the study. In act number 3, I'll summarize some of the major policy issues going forward. So let's go to the first act. What you see, whenever you see these graphs and you see these little dotted lines there, that's Latin America. And what you see is that Latin American financial systems have become deeper, but they have become deeper every place in the world. But they have become deeper at least at the speed in which Eastern European markets have become deeper, and they have become more diversified. No longer we have a completely bank-dominated financial system. We now have financial systems that have bigger bond markets, in some countries important stock markets, and the deepening in diversification is, I think, a clear thing in Latin America. First, when you look at the players in financial systems, it's no longer just banks. In Latin America, we have many asset managers, and we have a very important one. He's sitting with us, in fact, here, Arminio, who has had been a very successful asset manager. But institutional investors have become important. And Latin America is a leader among emerging markets in the development of pension fund management as a result of reforms that were initiated in Chile and then spread out throughout the region. Mutual fund industry is developing, and we are keeping pace with the rest of the world and other emerging markets. And in insurance, we are also developing an industry, although there's some lags there. But you see progress in all of those areas. Perhaps a very important feature in financial systems in Latin America is the de-dollarization of financial contracts. You see it in loans, you see it in deposits, you see it in bonds. More and more of the funding is done in a local currency, which means that our local currencies are now more credible, more reliable. People are willing to write contracts on them. In the past, we thought they were not useful to write financial contracts. We stayed away from those weak currencies. Now they have become more respectable currencies, and as a result of that, you have more robust financial systems and macroeconomy. Maturities have been lengthening. Latin America was known as a region for very short-term focus. It has been lengthening, particularly in bond markets, and perhaps the most important area is government bond markets. Financial products are wider. I was surprised to see that, for instance, in the factoring industry, which is this graph there, Latin America has been expanding at a brisk pace. But even securitization, which is embryonic in Latin America, is taking place. And now it's halted like every place in the world until we find out how we can control the risk in securitization. And a very important development in Latin America is related to the entrance of new players into the consumer finance market. Retailer stores and department stores have become very big, and here you see the big chunk of consumer debt that's financed by retail stores, for instance, in Chile. We are a very globalized, financially globalized region, but the type of financial integration into international markets has improved in Latin America. It has become more like in Asia. Here's Latin America, there's Asia. If you look at the red line, that is the position that the country has vis-a-vis the rest of the world in terms of debt contracts. And what you see is that Latin America, because of the accumulation of international reserves, has become a net creditor to the world. And it has become a bigger debtor in equity contracts because of FDI coming into the region. So when you look at this type of divergence between debt positions and equity positions, you see we're not very dissimilar to Asia, excluding China. So this is a much more robust way of integrating into financial systems, and this is one reason that explains why Latin America has now a more resilient financial system. Latin America is a region where foreign banks have made a lot of money. We have a lot of big name banks in Latin America, proportionally more than many other emerging regions. And there are countries like Mexico, where about 80% of the banking system is owned by big name foreign banks. There's a debate as to how useful that is for the local economy. We don't find them to be any better or any worse than big local banks in terms of usefulness to the economy, but they do bring modern risk management systems. Governments have intensified their commitment to financial inclusion, de jure and de facto, and as a result of that, Latin America has made a lot of progress in bringing people into the savings mobilization efforts. Poor families are now saving using the financial systems much more than in the past, except in Argentina, where they like to have the money under the mattress. But in most of the countries, people trust the banks a little more. And you see in Latin America, payment systems have become much more involved with financial systems. You have here, for instance, the penetration of ATMs in Latin America is quite significant. In countries like Brazil, you have this inclusion, particularly in savings and payments. And also in Latin America, you have had a very important revolution in microfinance. So Latin America has been keeping pace with the world and in some senses even leading in this inclusion effort. The progress in regulation supervision is remarkable. This is something that the World Bank and the IMF do, which is to see the degree of compliance with what's called the Basel core principles of supervision. And what you see is that the improvement from one year to another when we do these assessments. And what you see is almost in every country in Latin America, there's a strong progress in compliance with these international standards of regulation supervision. When you look at here, the blue area suggests that Latin America is doing better than countries with similar levels of economic development in many of these principles. In fact, if you look at the solid lines, that is where countries are expected to be given their per capita income and other controls. And what you see is that in everything that matters for soundness, Latin America is the champion. It has more capital in the banks, more liquidity in banks. It has better loan loss provisions. It has greater profitability in banks. So bank soundness has improved very significantly in Latin America. Latin America are the red dots, and whenever the red dots are above the line, that means that you are exceeding what is expected from you given your level of development. I won't go into the techniques of doing this benchmarking, but that's an important component of our study, is that we introduced a more sophisticated way of benchmarking a country relative to others and to its financial development process. So, of course, the variance is huge. This is some important services that Latin America has. The bars are where you expect countries to be given their level of development, and the lines are where you expect countries to be, and the bars are where they actually are. And what you see is that in industries like pension funds, many countries in Latin America are above where they are expected to be. In Chile, of course, is the big outlier. When you look at debt outstanding in corporate bonds, Latin America is also, in many countries, are above where they are expected to be. Mutual fund industry is not too bad for some countries. And even market capitalization is large enough relative to what Latin America is expected to be. But there's a lot of variance across countries, and you see that. And one thing that our report does not exploit sufficiently, perhaps, is the understanding of the variance across countries. Where are the gaps? Biggest gap in Latin America is credit debt. Here you see you have Latin America in the red dots, and this is the red line. And when the red line is below the zero line, it means that you are getting away from where you are expected to be. So Latin America not only has low debt, but it is getting farther from where it's expected to be. So that's perhaps the most important gap, development gap in Latin America. In Latin America, intermediation margins have been converging to the benchmark, but fees are very high. Particularly, it's a region where it's most expensive to open a checking account, full stop. So the banking is an activity where you find Latin America trailing its expectation. Perhaps this is very important. Credit has expanded in Latin America, mainly in the consumer sector. Here you go, the top bars, at the expense of credit, long-term credit such as mortgage credit, and to firms. So this is the thing that worries Latins the most. So we have these new, more stable financial systems, but all they seem to do is finance consumption. They are not financing business expansion, business investment, long-term finance. And this is an important gap, not only in the size of the credit in the financial system, but also in its composition. Second biggest gap, liquidity in stock markets. So we have stock markets that are fairly good size in some countries like Mexico, like Chile, like Brazil. But the liquidity is very low. And in fact, when you look at liquidity, control for a number of factors, including the size of domestic markets, we see Latin America is getting away from the benchmark in the red line. So that's a big problem for Latin America. In Latin America, the number of listed companies is small and falling. So it's a very illiquid domestic capital markets that's available only to the very few and large companies. Here are some signs that show you how few, a new issue of stock in Latin America comes about every millennium. No, it seems, no, I'm exaggerating, but there are very few issues, very few new activity, and liquidity is low. And then gaps in prudential oversight, you mainly find them in countries, in the smaller countries in Latin America, where the blue line is inside the benchmark, Caribbean and Central America. And let me now outline quickly the challenges ahead. So first challenge is closing the credit gap. What can we do about it? Well, we say, why in the world do we have such a small activity in credit and credit debt compared to where we should be? We find three main reasons behind that. One, the history of crisis. We estimate that a big crisis leaves you crippled for about 10 to 15 years. You see that in Mexico, you see that in Argentina. So the biggest problem with the size of our financial system has to do with the memories and long duration of adverse effects of crisis. The second big reason seems to be our environment of contracts, contract writing, contract enforcement. Latin America trails countries of similar economic development in the quality of judicial systems, collateral systems, bankruptcy systems, execution of contracts. So that seems to be a very important constraint to the development of financial markets because, as you know, the more sophisticated the financial contracts, the more you need enforcement to be in good shape. And the third one is just a very simple fact that Latin America is a low-growth region. So it doesn't have enough pull for finance coming out of the real economy, and the interactions between a financial system that's oriented towards consumption plus an economy that doesn't grow too much creates, again, a gap in credit. So what we say is that the challenges for us, for Latin America, essentially have to do with staying away from crisis, which will become trickier as we move forward, and second, in improving contractual environment. The improvements that Latin America has made in the informational environment are very significant. So that's not where the shoe is tight. Where the shoe is tight is in contractual. The problem is that you cannot import contractual institutions. You can import information technology and information institutions. And that's why credit cards in Latin America are as good as in any place in the world, because that's a technology that can be transferred across borders. But contractual institutions, that you have to work. And that's a problem that can only be having a boom. Okay. I have 5 more minutes. I can.
3.
Okay. Okay, I'll do this very fast. Second, we need to work on long-term finance. That's in shortage in Latin America. In some countries like Brazil, the only game in town is a public bank called BNDES, and the markets for long-term finance are not there. As you saw, one component of long-term finance that's hugely important is equity finance, and we have a huge gap there. And we seem to be, the diagnosis, what's behind that, perhaps the most important one that we identify is that the lack of liquidity in the domestic financial markets is not independent of the fact that Latin America, when it issues the stocks, goes outside. And when it trades the stock, goes outside. So, and those that go outside are just a few, the large. And so we have a shortage of equity capital in local markets, a problem that we need to find a way to solve, for which the solutions are not easy. Then we need to think about how to do for debt contracts and extending their maturity. That's a bigger problem, because there are many solutions. In the book we study one, which is the U.S. solution. And the U.S. solution has has shown to have pitfalls. In the U.S. solution, what you have is a huge maturity transformation, a lot of short-term positions in investors, long-term assets created, and in the process, a lot of systemic risk. And you have this liquidity fallacy, where you tell people, okay, please hold this 30-year security, but I promise that you can sell it tomorrow if you want. And so people think that they are really holding a very short-term security because of the liquidity, but that liquidity is fallacious, because that type of liquidity creates a whole set of free-riding problems when things are tranquil, and a whole set of problems when things become tense, as people fly out of those assets, creating major problems. So what is the path for Latin America to develop long-term finance markets is not easy. In Latin America has problems of its own. We identify incentive problems with asset managers and short horizons that can aggravate the problems. And what to do is not easy, but we highlight one point. Latin America is a leader in pension fund reform, using well the pension fund reforms to create an industry of annuity provision, of life insurance, as in Chile, is part of a possible stable solution to long-term finance, which Latin America needs to capitalize on. Then on the role of the state, as I told you, Latin America has gone back and forth on this. We have big messages in the report, and the one is that state should play to its strengths. The state is not good at solving problems of information asymmetry, at solving problems of collateral. It's not good at solving what is known as agency problems. The state is better at solving coordination problems, collective action problems. So what we say in the report is the state should play to the strength, identify complementarities, and work on those. And we have a number of suggestions on how that can be done. A lot of this can be done without the state taking risks. But we find spaces where the state can even take some risk and share risks, and that could be justified, but it has to be carefully done. And even then, the state needs to play with its strength. So the biggest message, I guess, we have in the report on the role of the state is that there is a valid developmental role for the state, as long as it plays to its strength and it's complementary to the comparative advantages of the markets. And we find that markets have a comparative advantage in solving agency problems, whereas the state has a comparative advantage in solving collective action problems. So there's obvious space for complementarity that should keep us busy as we think the role of development banks and so forth in Latin America going forward. And finally, this is the last slide, there is a need for the state to enhance its stabilization role through a new agenda of regulation and supervision. And we have three areas to emphasize there. One, that there's a stronger case in Latin America for the macroprudential agenda, because the Latin American financial systems are getting into the territory where there's a higher potential for excessive fluctuations in finance, which require new instruments. Monetary policy is already overburdened. But for macroprudential policy to work in Latin America, we make a big case that flexibility in exchange rate will be important. In fact, a flexible exchange rate will allow more independence in the implementation of macroprudential policies. Then we have this thing that we call microsystemic. Some people call systemic regulation. That's a new big area of regulation, new agenda, and it has to do with limiting regulatory arbitrage to a large extent, avoid a shadow banking type problem. But in Latin America, the problem is that we have tried to avoid the shadow banking by regulating everything that moves. And so we have an over-ambitious perimeter of regulation that needs to be revised as the system moves ahead. So how do you move ahead is an interesting topic. We discussed that in the report. And inside the boundaries, what we find is that there's a lot of regulatory arbitrage because in Latin America you still have silo approach to financial services, and we have not been able to develop good consolidated supervision. On the systemically important financial institutions, which is a topic of the moment, Latin America has a case to worry about that because our banks are huge. In many countries, one bank accounts for 20% of all assets. So the systemically important financial institution phenomenon is a very important one in Latin America, and the report deals with that and makes some suggestions. And finally, there's all of this move towards systemic supervision. This comes from the fact that during the crisis we learned that the world lived in a fallacy of composition. The way supervisors saw the system was that if I have each individual institution healthy, the whole system will be healthy. It was a fallacy of composition. it turns out that the system can be sick even if you think that each institution is healthy. So we need this new approach, more systemic approach to supervision, but that's a major and tall order because it will require solve major coordination problems between central banks, regulatory agents, and it also would mean to think about governance arrangement because the moment you move into systemic supervision, some discretion will be necessary for authorities to calibrate the systemic tools, and that's tricky. Economists don't like the idea of moving too much into discretion, except if you have good governance arrangements. Central banking is perhaps the best example. Central banks take decisions with a great deal of discretion, but they have a strong governance arrangements about that, which we need to think in the region as we move into systemic supervision agenda. Let me stop there.
Thank you, Augusto. Before turning to Professor Kalomiris, let me tell you also that after this first session in English, we will have a press conference in Spanish that will be also broadcasted around the world. So, Professor.
Pardon me, I'm stuck in the corner.
Yeah.
I'd like to thank the organizers of this event for including me. I feel very privileged and honored. Up here? How's that? Better? So I want to thank them. I think this is an amazing volume and it's an amazing event, and it's really a pleasure to be here. The flagship study is comprehensive and achieves its central goal of being more than a set of descriptions. Let me quote from it. The value added of this report hinges on its holistic view of the development process, its broad coverage of the financial services industry, not just banking, its emphasis on benchmarking, its systemic perspective, and its explicit effort to incorporate the lessons from the recent global financial crisis. I agree. The book succeeds in going beyond just the data, which too many, frankly, World Bank and IMF publications do. That is, just focus very narrowly on describing some data. Instead, this book takes stock of how far Latin America has come, what has propelled those improvements, especially political decisions to create stable macroeconomic environments and market-friendly financial sector policies, and what remains to be done. It also relies throughout the volume on a powerful and unified economic framework, one that integrates institutional change events, macroeconomic policies, and the microeconomics of agency problems and incentives in explaining whether and how financial systems develop. This is an honest and rich book full of useful facts and coherent analysis, which is written at a very high level. It takes on important topics, and even when it's hard to make definitive progress on them, it's balanced in its treatment and fair. Anyone who seriously is interested in finance and development, anywhere, but especially in Latin America, must read this carefully. My version of the background historical narrative that accompanies the facts and analysis in this volume is quite similar to the authors. In the 70s through the 90s, Latin America gradually moved away from their dirigist past of financial repression and lack of fiscal discipline toward a new future, in at least many countries, of financial liberalization, privatization, and fiscal reform. In this respect, it lagged behind Asia. In an article that Alan Taylor wrote in the mid-1990s, he estimates that financial underdevelopment in the 1980s and the early 1990s in Latin America, in comparison to East Asia, contributed 1% per year to slower GDP growth for Latin America, which he identified econometrically as operating through lower investment rates in Latin America. Now, Latin America wasn't always successful in those liberalization efforts. Chile, which is, of course, the early fast liberalizer, was also the early big financial crisis. Many of the most severe global financial crises occurred in Latin America in the 1980s and 1990s. But I want to emphasize this next point. There was constructive learning. There were some significant exceptions, Argentina, Venezuela, Ecuador. But overall, there has been a pattern of very constructive learning from financial crises and building institutions in response to the lessons of financial crises. That is a major theme, I think, of the recent Latin American experience. Indeed, thinking more globally, and I find that Latin American economists are way too modest and policymakers are way too modest, because I would say from a global perspective, Latin American countries actually have led the way in thinking about regulatory policies that limit systemic fallout, particularly from excessive government protection of the banking system and ineffectual Basel-type regulatory frameworks, which have plagued the rest of the world even more in recent times. I think that the study rightly recognizes that this aspect of trying to limit the deleterious effects of excess government protection of banks is a key aspect of regulatory success, and I think they may even underestimate the extent to which Latin American countries should be credited for this. I'm thinking, of course, particularly of Chile, but also even Argentina in the 1990s, Brazil, and Colombia. Now, banking stability and improvements and regulatory design that focuses on incentives have had several pieces to them. One is opening up foreign bank entry, which completely changes the political dynamic of regulation and the protection of local crony special interests or grupos. Also, designing credible limits on depositor protection, as the Chileans have been really at the forefront of doing and have been copied by many other countries. And I emphasize credible, not just saying that there's limits on protection, but designing them in a very careful and interesting way to make them credible. Relying on market-based incentives because of limited protection, as well as on government regulations, therefore, to discipline banks. Also, implementing effective macroprudential policies during the recent crisis. I would have liked in this study for there to have been a little more discussion of the Colombian case, which is worldwide the only truly successful application of macroprudential policy. And some Brazilians are going to complain when I say that, because the Brazilians did some interesting things too. But the Colombians successfully used capital requirements, liquidity requirements, provisioning requirements very consciously to stop a credit growth-oriented asset price bubble and achieve a soft landing. That's a remarkable achievement, and it happened only in Latin America. Spanish are going to be very mad at me, too. One thing that we haven't said yet, but I think has to be said, is that this occurs in the background of changes in macroeconomic policy, particularly the decreasing use of fixed exchange rates and the quasi-independence of central banks. I'm going to come back to that topic because it's still a glass half full, I'm afraid, in some cases, which have pursued inflation targeting rather than fixed exchange rates. And that's had a big effect on some of these issues that we've heard about, I would say, in particular, domestic denomination of contracts. So all of these have made recent Latin American financial reforms more effective and have given the well-governed Latin American economies great resilience during the recent global crisis, and again, particularly in Chile, Colombia, and Brazil. And in some countries, other good things are happening. Equity markets are growing, not only for secondary trading, but also for primary offerings. And here, of course, Chile's example, early example in the 80s and the 90s was very clear, but more recently, Brazil's Novo Mercado is a thought leader through its innovative approach to voluntarily improving corporate governance. And of course, that's been the story of the last decade in the almost miraculous growth in Brazilian equity markets. Access to finance more generally, as the authors point out, is broadening. That is, it's not just a select few. Of course, that's a more general fact. That is, throughout the world, when we see that whenever finance expands, access expands with it. So that's not something that's unusual about Latin America. Derivatives are expanding. Of course, in theory, we'd expect they would offer diversification opportunities, especially for this primary commodity-relying region. Surprisingly, the authors find that exchange rate derivatives have been not really growing relative to GDP. I think that's an interesting finding that requires some more discussion. while interest rate derivatives have been growing much more dramatically. That's a very interesting finding I think that we could spend some time talking about in the question and answer. Maybe that reflects less perceived need to insure against exchange rate changes in these fixed exchange rate regimes of the past. And it may have something to do with the change in the monetary policy and local currency debt environments. I don't know. Now, growth in institutional investors has been mentioned. This is a key and underappreciated development, by the way, in the United States in the 1960s and 70s. So I want to emphasize that there's a lot of good historical precedents. 1 minute, yeah. For the, I'm sorry, that's a surprising fact.
Yeah.
So I think, yes, so I think it's important to recognize that this isn't just a hypothetical or just the experience of Chile that we should be looking at, but the reason why the United States developed deep equity markets, which we did not have prior to the 1960s and the 1970s, was the growth of institutional investors as repeat block buyers in equity markets, not just managers of stock, but because of their repeat block buying in equity markets, they developed better information processing capabilities, and they held investment banks to account more for their communications of facts. With respect to aggregate links to the rest of the world, Latin American countries' financial globalization positions become much more stable. They're less risky, more diversified, less levered, and more liquid. Sovereign debt is now starting to become locally funded. Reserve balances are higher. Corporate bond finance is lengthening in maturity. Of course, this is still confined to a very few firms. So let me turn quickly to the gaps that are noted in the study. So as the authors note, banking credit depth and equity market depth still remain low compared to benchmarks. Savings is, of course, very low and has been for a long time compared to those East Asian benchmarks. Part of this comes from demographics, part from lags in catching up to these institutional changes that are still fresh. Part of it in the recent past, of course, has to do with the contraction of foreign banks' operations in Latin America. You could call that the dark side of foreign bank globalization. The flagship book reasonably hypothesizes that the various aspects of financial development are occurring at different phases, reflecting the fact that some frictions that need to be overcome are more easily overcome on some dimensions than on others. I think that's the most interesting and original point in the book. I like the way the authors develop it in Chapter 2. I like the graphs in Chapter 2, which I recommend to you, and this notion of differing convexity of growth paths for different dimensions of financial development. I think that's an area that's going to inspire a lot of future research. Okay, I'm going to, given the lack of time, I'm going to skip ahead and talk about equity offerings. Now, equity offerings have not been keeping up, and they're very concentrated really in only two countries, Chile and Brazil. What's going on here? The authors note that there's a problem of liquidity given that issuers like to concentrate their offerings in foreign markets, but I agree with them that this is not the main problem. And where are we going to find the main problem? I also agree with them, and I would point more specifically to René Stoltz's very important work on the limits of financial globalization of stocks. So as Stoltz has shown, and many others, including some of the work in this book, equity markets in developing countries, and in Latin America in particular, have had major agency problems to overcome. What Stoltz quantifies as the twin risks of expropriation. Expropriation of minority shareholders by majority owners, and expropriation risk of all shareholders by the government. And he models and shows in his empirical work that both of those kinds of expropriation risks tend to favor insider majority ownership and very constrained participation in equity markets. The roots of that, I would point out, I'm not going to have time to talk about problems of central bank independence and some other issues, but I do want to come back to this central issue of these are not just physical problems, these are political problems. And so I'll end with a shameless advertisement for my forthcoming book with Steve Haber, which is called Fragile Banks, Durable Bargains. And the durable bargains part of that book refers to political bargains. And in the book, we present a new political theory of why financial underdevelopment is the rule often in world history. 2 of the 6 country studies in the book, by the way, are Mexico and Brazil. The overarching lesson of our book is that poor financial system performance reflects the dependence of financial systems on the political environment. If Latin American countries are going to progress further, it will be because their political systems focus on credible means for protecting financial property rights broadly defined within stable democratic political systems. And I would say that is the main constraint for us to be focusing on. I also want to remind you of an old political scientist, Charles Lindblom, who wrote in the 1970s, and it's very parallel to what the authors talk about, the limits of government involvement. He said, government is best at doing things that are like what your thumbs do. Push hard, that's those coordination problems. Whereas the market's best at doing things like what your fingers do, delicate operations. The problem is, of course, many Latin American governments like to play the violin with their thumbs.
Thank you, Professor. Thank you very much. Let me turn to Arminio Fraga now.
Thank you. So like Charlie, I like to say how impressed I am with this book, having spent a lot of my life studying and practicing both on the government side and the private sector side. I must really recommend that you read this book, and if you're a specialist, that you read it carefully. I don't have much time, so I'm going to skip the rest of my compliments and go straight to my 3 topics. I decided to just narrow it down to 3, and here they are. The first one is the subject of short maturities and also of the excessive focus on consumer lending rather than investment financing. So the first question is why? Why is this the case? Why are maturities so short? They seem to be short on the liability side everywhere. That's a huge problem. Let's leave that out for now. So first is macro uncertainty in general. And we now are doing better in the region, but we have a long history of high inflation, currency crisis, and so on. The second has to do with legal and institutional risk. So the lack of mortgages in my own country, Brazil, is a good example. For years, there just wasn't anything because mortgages really were not a good instrument to lend, largely because lenders could never repossess. That has changed. I won't go into that now. It's really an interesting evolutionary tale within our legal system. Similarly, one could say that, and this maybe 10 years ago it was significantly worse, but a large fraction of the lending that takes place in the region is de facto uncollateralized. Less so now, but it used to be probably 90% of the lending was uncollateralized, even though it may, on the surface, look like it had collateral. It really didn't. I also think it has to do with old habits and lack of sort of a slow learning of some things. And in the case of consumer lending, we also have to think of sort of a fine line between building and encouraging citizenship and then populism. You can very easily cross that line and jump into populism. It is amazing to me, again, that, say, in Brazil, as a country I know well, consumers borrow at such astoundingly high rates. So that's kind of the why short maturities and consumer focus. What to do? Well, the book discusses this in many ways. I find it very appealing to start with institution building, and the book mentions pension plans as a natural long-term investor, insurance companies as well. I'm a big believer in this case of having, through regulations, enforcement of matching of balance sheets. And this creates sort of a nice supply of long-term funds. No question, further effort on the macroeconomic front is warranted, but we've come a long way there. And I also think better information for borrowers, sort of a consumer protection effort, could help. An appendix to this subject has to do with risk management. It occurred to me listening to Augusto about the benefits of integration and so on. I hope that the risk systems used, however, in the more mature economies are not imported to our region. I don't think they did a very good job. We have had for a long time, in fact, not so much because of merit. I don't want to pound our chest too much here, largely because we went through all these crazy events in our history. We had a pretty good idea as to the importance of keeping things pretty simple, not allowing for too many things to happen off balance sheet that you couldn't see. In fact, as far as I can tell, when I was in government, we tried to have nothing off balance sheet, consolidate everything, and think about stress. Obsessively think about stress. That really is the only thing that matters. I'd recommend you do the same if you're an investor too, by the way. And then the other thing I want to mention that is also maybe just a Brazilian thing, I don't know, but that has worked pretty well for us is that our banks, and particularly, well, our banks have an interesting feature in their governance. Bank owners, when they have a controlling shareholder, and most do, as well as senior bank management, are personally liable, no questions asked, in case of a bank going under. So the bank goes under, you keep your home, nothing else. That's pretty good, and that has helped. So that's topic number one. Topic number two is state banks. So I want to say a few words on that. As many of you know, I'm sure, government-controlled and managed banks have a long and inglorious history, not only in our region, but in many parts of the world. China being probably number one in the list. The effort in the mid-90s in China cost about 80% of GDP, of their GDP, and the cleanup effort. And in Brazil, we also have had a very interesting history. Someday I'd like to write a book about that alone. And the problems are well known. There are quasi-fiscal problems all over the place. I find it to be also very non-democratic, that sort of budgetary allocations take place sort of outside the budget, which is the proper institutional sort of Republican way of dealing with this. But this is a recurrent issue. Second, and equally important, is the problem of efficiency. And it sometimes escapes the attention of policymakers that not only do one need to invest to grow, but that you also have to invest well to grow. And this is a very obvious thing for a business person that knows that if you invest your money poorly, you go bankrupt. But sometimes this is not so obvious at the macro level. And I find the issue of capital allocation efficiency to be a big problem here as it relates to state banks. Now, this is a subject that could keep us here for hours, days. Let me give you a few thoughts on what to do that I think are linked to the report or mentioned in the report. First, thinking of our case in Brazil, long-term lending from development banks and our own in particular have played an important role. However, I think the time has come for us to require mandatory co-financing by the private sector. There is now a liquid, transparent market for long-term treasuries in Brazil. You can buy a 40-year inflation-linked bond in Brazil. And I really see an opportunity for us to force the private sector to be creative and to build this market. There's some effort at really creating a culture of research, of understanding of that. So mandatory co-financing, I think, would be a good idea. Second, it relates to lack of transparency. I think government banks in general have to be particularly careful about what they're doing. They're lending precious, typically subsidized money. I think it would make a lot of sense for the criteria behind the lending that government banks do be spelled out, and that it is done very transparently. Third, we have to make sure, this is a tough one, we have to make sure that all government banks are also supervised by whoever does bank supervision, typically the central bank. They should not be treated any different just because they're controlled by the government. And lastly, there should be a mindset that I think is behind the idea of say, requiring co-financing, that that government lending should supplement rather than substitute for markets. A lot more thoughts. The subject is discussed at length in the book and is, I think, a hot topic in many parts of the world. The pendulum keeps going back and forth, usually overshooting, and I think we overshot in one direction, say in the 50s, and then went the other direction in the 70s, 80s, and it's probably about to overshoot again back towards the more dirigist approach. And we should not repeat the mistakes of the past. On state banks stabilizing things, I have my doubts. They clearly seem to be pro-cyclical in the upswing. In fact, they seem to be always, I should say, pedal to the metal, if you will. And I'm not sure there's that much that the central bank can't do, quite frankly. But it's a good topic of discussion. My third and last point is a quick one. Is a couple words on capital markets. Professor Calamiris mentioned the important development of stock markets in a few countries. It is, of course, as Augusto alluded to, not easy for the smaller countries to develop their own markets for lack of liquidity, but it is doable. We're very pleased with our experience in Brazil. I would say at the top of the list came a real revolution in corporate governance. It came from the private sector. I was in the government at the time, was very happy to see it and to try to help, but it was primarily done by the Bovespa. And it has really been phenomenal for us. As you know, government banks typically provide loans, but there's still a need for equity. Even the most aggressive banks will not lend if there's no equity. And so stock markets have been really a breath of fresh air. They have allowed entrepreneurs, local entrepreneurs, to have access to capital, and this is very good. In the past, either you belong to a long established sort of large family group, of which there are usually a few in each country, or you were a global company, or you had no chance. And we have now in Brazil a large number of stories of success that are really inspiring. Quite a lot of work and the right kind of work, because it typically comes with good governance. Once you have a stock market that's up and running, then you get what one could call a food chain, because you have also private equity feeding into the stock market. If you don't have an active stock market, you can still have private equity as a business, but it's much less interesting and much more difficult to do. And then once you have that going, you also have venture capital. That is usually more related to innovation and is smaller. So it goes through that first filter. If it manages to go up a notch, it can then attract private equity capital, and then beyond that, go to the the stock exchange. Exchanges in general can and do increase transparency, and they help mitigate risk, provided, of course, that they manage their own risk. And so it's not exactly a panacea, but it definitely plays, I think, a good role in Brazil. For instance, the exchange. I'm the chairman. Full disclosure: I'm chairman of the board of VMF Bovespa right now. But the exchange in Brazil has something that doesn't exist here in the States. That is, the exchange has access all the way down to the end counterparty, instead of just staying at the brokerage level. It's really sensational. You can aggregate things quite well and watch for undue exposure across the system, and it's been quite good. And that's something we've had for a long time. Anyway, those were my thoughts. Again, congratulate the World Bank. I remember very well years ago, I guess it was in '99, Brazil was one of the first countries to do an FSAP, a financial sector assessment program. And I was there at the time, and the World Bank and the IMF together were really extraordinarily useful for us and very helpful in doing quite a lot, and I'm thankful for that as well. Good to have a chance to say that in public. Thank you. Thank you for your time.
Thank you, Arminio. So we have some time now for your questions or comments, and you can pose the questions to Augusto or to the panelists, and I will ask you to identify yourself. A microphone will be available. Yes, the gentleman first. Yes.
Thank you very much to all for your presentations. Tom Trebot here from the Institute of Latin American Studies. One issue is ownership and concentration of ownership among banks. Several of the speakers, I believe, Dr. De La Torre mentioned that, and they also mentioned, I think, Professor Ramirez, the dark side of having a lot of foreign bank ownership. So I'd just like to pose a general question of ownership, concentration, foreign ownership, whether reforms and rethinking is needed in that area. Thank you.
Thank you. Let me take another question, take a round of three, and then I get back to the panelists. Yes, go ahead.
Thank you. My question is for Arminio Fraga. My name is Lucia Martin. I'm PEPM student. Regarding the capital markets and its penetration, its participation, and its size, my question is, what is your opinion about this, the presence of family firms and these concentrations in the firms in the stock market? Because, well, I find two facts. One is that these firms lead the movements, at least in specific sectors, in telecommunications, food sector, infrastructure. And the other fact is that for these kind of firms, capital markets is not the first source of financing. So I know that Brazil is a successful case in Latin America, but at least in Mexico, we implement all these changes with new rules. We had a new law for capital markets just 5 years ago, I think, and we changed everything in corporate governance, and the size of the capital market in Mexico is still the same. So, like, what can we do?
Okay, let me take another question if there is any. Yes, in the back, please. Yeah.
Hello, my name is Zena Al-Kouri. I'm also a PEPM student. My question is related to international bank ownership, especially in Mexico, for example. How much will, I just want to have an opinion on how much do you think that this will hinder the growth of credit, which is very much needed in the region, especially because, for example, they have European ownership also, and now with the crisis, what will be like the spillover effect, and how will this hinder the growth of credit in the region? Thank you.
Okay, thank you. So we have three questions. The first one basically related to bank ownership, concentration, and also foreign ownership. And maybe Augusto, you can tackle that one. Then we have the second for Arminio on capital markets, and the third one on the foreign ownership in banks and how that can affect the spillover from the Eurozone crisis. So we'd like to start, Augusto.
Okay. Just a few thoughts. I think that the phenomenon of high concentration of income and wealth in Latin America is reflected in the way in which financial markets work. So part of the problems with liquidity in capital markets, one can ultimately attribute to the fact that you have high concentration of ownership in stocks and in other equity. So this is something that's very structural and underlies much of Latin America, something that you cannot solve quickly, and it requires more aggressive distributional policies that don't affect growth. But the issue of foreign bank ownership has become, I think, a hot issue now that a little bit the concern has risen, which was not seen when we attracted the foreign banks. We thought when we bring foreign banks, we bring kind of a lender of last resort in our land. We bring a bank that has access to liquidity outside, and so will make us more robust. Now we're afraid that we will lend last resort to Europe or something like that. So the thing has been reversed. The concern is the fact. I think the concern is with the fact. The way I put it, the way I think I would put it is that if you have an international bank that has operations in Europe and the United States and in Latin America, it may be that the interests of the host country are not well internalized by the interest of the parent. And you may have a tension of interest where the parent may want some things that are not in the benefit of the host country. And one interesting proposal in this regard came out of the Central Bank of Mexico. They have this idea that may actually be implemented where they say, okay, we will not only bring a foreign bank here and force them or ask them to be a subsidiary so we have more regulatory control over the bank and we see their operations, but we also are going to ask foreign banks to issue stock and have another owner that can represent the interest of the local market. That's a proposal that's there, has been floating for some time, and I suspect that in the current conditions it actually may become implemented because you need to balance the stakeholdership and interests at the local level. Fortunately, the international banks that operate in Latin America not only operate through subsidiaries, which allows better control through supervisory and regulatory policy, but they also are funded largely internally. So they are not, unlike Eastern European banks, they are not dependent on funding from outside. And therefore, in that sense, our foreign banks are more robust.
All right, let me turn to Arminio.
So on family firms in the stock market, it is true most businesses were family-owned in one form or another, or more recently owned by entrepreneurs. So they're the first member of their family, but they own it nonetheless. And this has not proven to be an obstacle. And I second what Augusto just said, because I think it's a more serious problem is to have a lot of concentration across industries in a given country. It's probably the case in Mexico than in Brazil. But what has come out of it that I find interesting, and it's also common, is the need for different aspects of governance to play a role. So if you are a company controlled by a family, the key need is to protect minority shareholders from, say, expropriation by controlling shareholders. Whereas if you are a corporation, and we have a few in Brazil now with no defined control, the key governance challenge is to control management. And it's different. There are things in common that have to be done for for you to be able to see good governance. But this is a very important difference. One case, the sort of problem lies in what management can do, and in the other is what the owner/manager can do to minority shareholders, and you have to deal with both. But this, in general, this has not been a problem, and the markets have learned very fast. And if I could say, I think right now, markets have gone way past where we started. We started with the rules of the Novo Mercado that were sensational, and also with the appearance in Brazil of a Brazilian Institute of Corporate Governance that has been training board members and publishing standards, has also played a role. I think markets are now on their own. They still look for these benchmarks, but they go deep and they try to figure out exactly what each company is up to, and then they invest accordingly.
Thank you. I think that, Augusto started to answer also the question number 3 about the potential spillovers of European banks in Latin America. I was reading that Banco de Santander earnings worldwide, Latin America represent more than 40% of their earnings. So maybe the panelists can also say something about that.
Well, let me talk about just 2 issues that have come up, one having to do with concentrations of ownership, particularly in banks, and the other having to do with foreign ownership, which is also related to this. So concentration of ownership per se can mean very different things. The things that we care about are 3 things that can happen as a result of concentration or not, depending on the political circumstances. One of them is, how competitive is the system? Secondly, do we have equal participation in the system? That is, not just is it competitive in terms of the players themselves already in the system, but do we have some sort of favored access to being able to participate in the system? And third, does concentration create a greater likelihood of protection from the government to the banks? Now, in many sort of, to use a tired word, crony capitalist environments, there's no competition, there's no open participation, and the fact that you own one of the 3 or 4 banks is an implicit contract for protection. But that's not generally true. So let's contrast the experiences of Canada, Brazil, and Mexico. All 3, you could say, were fairly concentrated systems. Canada hasn't had a banking crisis since 1837. And during that one, no banks failed. It's also provided very stable, not just stable banking, but a lot of credit to a widespread population across a very large terrain. And it's done so very competitively if you look at interest rate spreads. So I think that there's not equal participation in Canada. They keep American banks out, by the way. There are no American banks allowed to operate there and haven't been forever. But there's participation, and they're not chartering any new ones, to speak of, big ones. So you see where I'm going. So you have to look at all 3 of these dimensions. Mexico, of course, I worked for the Mexican Superintendency in 1999 and 2000. And we had a near-death experience when Bancomer was almost going to be taken over in a hostile offer by Banamex instead of BBV taking it over. And they hung tough, and the government fought back. And why did they fight so hard? Why did the superintendency fight? Because they knew that what Banamex was trying to do was create a bank that was too big to be responsible. That is, to have so much size and domestic political clout in its ownership that it couldn't be said no to. And that was the crossing the Rubicon for Mexico when they decided not to allow that to continue, and it has transformed the political economy of banking. Now, coming back to, now what about Brazil? Someone's got to explain to me why you can make so much money for doing so little as a Brazilian banker. There's just something that stinks to high heaven about the Brazilian banking system. And I still haven't really been able to understand how they managed to conspire effectively to make so much money for doing so little. So maybe, Arminio, you can explain that to me. It's a world miracle. I haven't seen it for a long time. But I do want to emphasize that foreign ownership, yes, it's a problem right now, and there have been lots of studies showing this, that the foreign banks are contracting. But, you know, it's the bad moment in a story that has been remarkable, not just in terms of access to credit, but changes in the political economy, which are long-term and fundamental, and it's the best and most important thing that's happened in throughout the developing world, but especially in Latin America, the getting rid of that concentrated, domestically controlled, politically influential ownership. So maybe we'll see Brazil open up a little too.
All right.
Should I say a few words?
Sure, go ahead.
No, I'm not here to defend our system, and I'm not a banker. It was one of the first things we did back in '99, at least when I started, was to start measuring bank spreads and publishing them, and then we produced a study with a diagnosis of why they were so big.
Why is it?
And they were so big at the time. They're about half of what they were now. They're half now of what they were when we started this. But it includes risk, costs, taxes, reserve requirements, et cetera, et cetera, et cetera. You really can't explain spreads that are that big without multiple kind of contributions, let's put it. Returns on equity have also been declining since then. And so, I actually think this is definitely moving in the right direction. I think you ask a very good question. The system is somewhat concentrated, but it has two large government banks in addition to the National Development Bank, two large local banks, and two large foreign banks. And I think that has helped. That balance was not achieved by design, but it's kind of nice. There's a little symmetry in it that hopefully over time will help. I think there's still a long way to go on the quality of credit sort of laws and instruments. They're still maturing. But they're moving in the right direction. We had this fascinating legal evolution where most lending used to be housed in our civil code. We're not a common law country. That's very anti-creditor and anti-business, and is migrated over the years towards our commercial code, for the lawyers in the room, that has turned out to be significantly more flexible, and spreads have collapsed in the areas where that has come into place. A nice little paper that could be easily written about our experience. Anyway, I could give you a long speech on this. Many of us have been concerned with this over the years. And I do think, however, without feeling like defending anyone, that at least the classic indicators are moving in the right direction. Returns on equity now are I'd say, kind of normal in Brazil. So the spreads are there, but there is a lot of stuff that goes into it. Thank you.
Thank you. We have time for one or two questions. So are there more questions? So we go to the back here, and then Professor Calvo.
Thank you so much for your fascinating lectures. I just had a couple of comments or questions. All of you made a sort of case for contract enforcement and property rights ownership in your speeches, but there is enough evidence in literature that the theory does, in empirical studies, do not suggest that they do help financial integration. So maybe you can shed some light on that. And Professor Calamari also, suggested that financial property rights have to be enforced. So I would like you to, elaborate more on that. And why didn't you mention microfinance? Because it has been a success story in Asia. So maybe you can talk about that.
Okay, thank you, Professor.
Thank you very much. Well, the panel has not disappointed me at all. Thank you very much. It was great. I have a couple of questions related to the discussion. One on the high rate of return on banks, or maybe lack of competition in the Brazilian banks. And if you can see any connection between that and that regulation according to which the managers of the bank are responsible 100% for what happens there. Because if you have a condition like that, you may be given incentives to have high profitability just to protect yourself and maybe be less efficient. I don't know, but I'd like you to comment on that. The other point that you raised, many of you, several of you raised, is on the role of national banks. I thought I had a strong opinion against national banks, and especially looking at BNDES and maybe lack of efficiency and all of the things that you mentioned. But when I look at what happened around the Lehman episode, the National Bank was the only one that really expanded credit at the time. I don't know if that made a big difference or not, but all the others, we look at the numbers carefully here, you see a sudden stop of credit, a very large one, like in the rest of the region. So there was nothing special about that. The only one that expanded was BNDES. Now we know, of course, that how the movie continued. That once the BNDES did that, then they got stuck at high levels of credit, and maybe that has a lot to do with the high fiscal deficit that prevailed for a while. I don't know. But I would like some reflections about that. Whether, if not BNDES, do we need? Can the central bank do something much more proactive during a period of stress? I know that when you were at the central bank in 2002, before Lula, there was kind of a credit crunch, and the central bank found a way to channel funds to the export sector. But we do that once in a while, and you need a very creative central banker to do that, and who knows, you had to play a very delicate political game at the time. But the question is there a role for a national financial institution to help out like that in periods of stress? Thank you.
All right, thank you. So property rights, the issue of microfinance, regulation, and how it deals with the management's responsibility, and the issue of national banks. So maybe, Arminio, you would like to start, and then we go to Professor Calomares.
Sure. So on the first part of Guillermo's question, I'm not sure. I would have thought that if you had, I guess if you're looking at high returns on equity over time, that may be the case. But in general, I think if you don't have limited liability, you tend to want to take more risk. And I guess it also depends on what sample you're looking at. But my intuition would go the other way. They tend to be more conservative. They try to, at least as far as I can tell, avoid the really crazy things that trading desks did all over the world. Switzerland's a good example, with heavily concentration on subprime exposure that they didn't even really know was there. On the counter-cyclical role, it's I guess it's one of those pros and cons things. It says at that exact moment, it's probably a good thing, but I'm also convinced that the government-owned banks tend to be just more aggressive in doing certain things all the time, and then they just don't stop, if you will. I don't have data. I think for the most part, if you have a more stable economy and you go through sort of a standard business cycle, the central bank should be able to take care of it. That's what I think. If you're in a very extreme situation, it may be the case if you have banks that are not so concerned with losing their funding that they may continue to do business. Of course, you don't want the banks to be making poor loans. So I'm trying to find the exact case where they might be in a position. I think that's probably the one I always thought might be reasonable. But then when you look at the overall impact of what they do, you're back to what I mentioned when I was at the podium. Is it worth it? I don't know. I think this is worth studying, and I think it's a very good question. I'm not sure. My instinct is that you don't want to go crazy on this. I think the costs are probably very high relative to the benefits. Particularly if you as a country, if you're not blowing up, if you're not the one, your central bank can expand very aggressively, and Brazil has been in this position recently, and it's worked out pretty well too.
Thank you. Very briefly, please, because we need to move into the Spanish section. Thank you.
One of the most interesting things relating to, I'll do Guillermo's first. The most interesting things about the Brazilian experience was, prior to 2008, I met with some of the Brazilian supervisory people, and I said, you have a problem on your hands because legislatively, you don't have a capacity for the government to give fiscal funds to banks. But you do have state-owned banks. And so when a crisis hits, what's going to happen is you're going to have state-owned banks acquiring private banks because it's the only pocket. And that's, I think, exactly the problem, was the constraint. And it's a reflecting of a real political economy that's good, which is trying to constrain government bailouts. But what it meant was the path of least resistance was the state-owned banks. Also, even the central bank during the crisis didn't lend a dollar. Now, of course, they twisted arms of the large banks to lend to the small banks. That's what they did. Again, because the politics is so toxic for the central bank to lend that they didn't want to have to show that they were lending. So I think that the efficient economics has to be reconciled with the toxic politics, which is a good thing in Brazil, right? They're trying to limit these bailouts, but it has put limitations on what you might call sort of efficient economic policy. On the first point, I think microfinance, or the first question, microfinance in Asia is not such a big success in my view. Take my emerging markets course and we'll talk about that. Maybe there's some interesting models in microfinance. Equity Bank in Kenya is the one I'm going to teach about next semester, more advertising. But more importantly, your first question was about property rights versus law and has property rights really mattered? And I want to emphasize this literature is now very rich and there's a clear answer, which is if you think of property rights in a legalistic sense as British common law, blah, 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 that's going to be transported into a country, it's not relevant. There is no robust statistical correlation. But if you think about property rights more broadly, to include risks of expropriation as well as effective legal protections, there's huge and robust evidence that it matters very much for banking system growth and for equity markets.
Well, thank you very much to everybody. Thank you to the panelists, to the host, and we will have a 2-minute pause now until we move into the Spanish press conference. Thank you very much.